Welcome back, everyone. On today's episode, we're going to be looking at an interview of Steve Eisman. He went on to CNBC and shared his thoughts on a lot of different subjects like he has before. Now, out of all the people to listen to, I think Steve Eisman is one of the best. I think he's really level-headed. I think he understands what he talks about when he gives opinions on subjects. I think they're well-informed. He has a lot of correct calls, not just the big short in 2008, where he shorted the banks. He understood their balance sheet and knew they were going to go down. But he also has made a lot of calls just recently that have been correct. He said that solar companies were not a great investment in 2023, or housing companies, mortgage lenders, anything to do with cars. He was correct on basically all of that. And I believe his input is generally worth listening to. So let's go ahead and jump into this interview here. The first thing that he mentions is that he believes the market has gone up too fast. He thinks that investors are getting a little bit too excited right now.
I mean, think of it this way. Let's say we were here a year ago. Most of your guests would have come in and said the earnings of the S&P are going to be down. The market's going to be down. The economy is going to go into a recession in about 15 seconds. And none of that happened. The recession that never was. And so the market climbed the wall of worry the whole year. So now here we are a year later, and everybody is, including me, has a pretty benign view of the economy. The only thing that bothers me is just that I don't think we're necessarily wrong on the economy. I think we're probably right. It's just everybody's coming to the year so bullish that if there are any disappointments, what's going to hold the market up? But I think long term, I'm still very bullish. But near term, I just worry that everybody's coming to the year, feeling too good.
Steve brings up an interesting point here. The market raced up at the end of 2023 into 2024. Investors are very excited. They're happy about the New Year's, and we had the Christmas rally. Everything seemed to turn out better than expected. But now we've priced things to continue being better than expected, or at least really good into the future. It's one of those scenarios that's difficult where we have things at the high end of the scale. We're pricing things highly, and if we have any disappointments, he's asking the question, how is the market going to handle any type of disappointment? One thing I think is interesting to look at from time to time is the forward PE of the stock market, of the S&P 500 in particular. The Wall Street Journal gives you the weighted average forward PE of the S&P 500, and today's price, based on next year's expected earnings of the S&P 500, it trades at a 21.5 multiple. So SPY's trading at a 21.5 forward PE. Now last year, it was trading at an 18.5 multiple. So it's gone up in valuation quite a bit year over year, from an 18.5 to a 21. So based on the average historical valuation of the S&P 500 on its forward earnings, things are at the high end of the scale. They're a little bit higher than normal. Now, I'm not saying that it's an extreme bubble territory or anything like that, but the market's trading with a little bit more bullishness. Things are priced a bit higher, and it wouldn't surprise me if we continue to have a bit of a pullback. That shouldn't be something unexpected. So I agree with Steve Eisman's cautiousness or his nervousness about how bullish the market is. I haven't been doing a lot of buys recently. I've been waiting for a little bit of a pullback to see any type of weakness in the market. Now, moving on, he talks specifically about big tech and the Magnificent Seven. Should you stay invested or be invested in the Magnificent Seven even after their massive rally in 2023?
I still think, you have to have at least a significant percentage of your assets in the Magnificent Seven there.
That's a pretty incredible line from Steve Eisman. Even after the enormous outperformance in 2023 of the Magnificent Seven, he still suggests to investors that you still need significant exposure to the Magnificent Seven. His reasoning for this has remained the same for a long period of time. The Magnificent Seven, big tech, that's where commerce is happening. That's where the economy's happening and transactions. If you're trying to invest outside of that, you're going to have a very difficult time keeping up with the market. So even as a value investor, Steve Eisman still believes you need exposure to these big companies. Now we'll continue on, and he highlights some other themes in his portfolio.
Talk to our investors about infrastructure. 1.2 trillion is still going to get spent in the United States over the next 10 years. First time we've had a industrial policy in the United States of America, probably since anybody in this room's been alive. So that's a big theme. So I think there are a lot of...
He mentions infrastructure, and he's been beating this drum for a while. I think it's something unique to Steve Eisman. I don't see a lot of other people going into infrastructure or stressing that as an investment opportunity. When I think of infrastructure, I think of Berkshire, maybe Brookfield Asset Management, BN. I think those companies are in the infrastructure territory, but I'm still not sure exactly what companies Steve's talking about when he mentions infrastructure. Moving on, he does mention banks, and he's always going to get asked about banks because he is the big short investor that made his name, his reputation, shorting the big banks. And so far, from what I recall, over the past year, Steve Eisman has said that banks are uninvestable. But let's go ahead and see if his opinion has changed in 2024.
I mean, let's pick on one bank. I mean, and I have no position in this bank, and I have nothing against the company. It's like Bank of America. So Bank of America is a very well-run bank. It's got a very good CEO. That doesn't mean they haven't made mistakes. They bought a hell of a lot of long-term bonds at the wrong point in the cycle. It's not a balance sheet problem. It's more of an earnings problem. So the earnings, if you look, are basically flattish for the last few years, up and down by just a little bit percentage. So how are you going to make money in Bank of America? You're going to need really two things. You're going to need the Fed to cut rates, so that'll help people's perception of the balance sheet. And you need no recession, so benign credit. Now, could that happen? Sure.
What he outlines here, with all of these things needing to fall in place for Bank of America to grow their earnings at all, that really does not make up the qualities of an attractive investment. So I can see from his viewpoint why he's not invested in banks. I'm not invested in them either. I agree with him. Now, the next thing that we get Steve's view on is interest rates this year. The market is pricing in this bullish stance of 3 interest rate cuts this year, and Steve Eisman does not agree with this.
I'm actually of the view, the market seems to think the Fed's going to cut rates at least 3 times this year. I, at this point, don't have that view. I think the Fed is still petrified of making the mistake that Volcker made in the early 80s, where he stopped raising rates and inflation got out of control again. So I'm not that bullish on the Fed cutting rates. And if that's correct, I think it's going to be hard to make money in the big major money center banks. Now, that's not a company-specific call. That's a real macro-y call. It's hard to make a long-term investment case for the banks when you have to deal with so many macro factors like that.
Again, I agree 100% with them. I think it's very difficult to invest in companies on the basis of interest rates doing certain things in the future. But there's many investors out there that will bet on these macro factors. I'm not one of them. Now, another big theme of 2023 was artificial intelligence. That was something that was headline news all across 2023. And we know that there's some big winners in AI, specifically NVIDIA. Well, we get to see Steve Eisman's view on how artificial intelligence will impact the earnings of companies in 2024.
Other than NVIDIA and maybe AMD and, maybe some Microsoft, I don't think you're going to see that much of an impact on earnings in tech yet. It's still going to be very story driven.
Now, this was a bit surprising. He's saying that other than big tech like NVIDIA and a few other big companies, you're probably not going to see that big of an impact of AI on companies' earnings in 2024. It's mostly going to be a narrative-driven thing. I think I agree with that for a lot of the stock market. There's many companies that really aren't going to benefit that much from AI. For example, I can list off Costco. How does Costco really benefit from AI? I don't think at all. And I think there's a lot of companies like Costco that they can try to, have customer service bots or something. But other than really small things, they're not going to make drastic changes. But that's a portion of the stock market. I think there's a huge portion that's going to benefit. Lots of software companies, Salesforce, Intuit, CrowdStrike, all these tech companies are integrating AI into everything they do. Now, they've been doing this for a while, but AI has advanced dramatically over the past year. So maybe overall, with the entire stock market, AI won't have that big of an impact on earnings. But I think with the segment of tech companies, software, any type of data company, a lot of the type of companies I like to invest in, AI has a disproportionately big impact on these companies. They are integrating it into everything they do. If you listen to the earnings calls on companies like Intuit, they are leveraging AI with almost everything they're doing with these companies. So I both agree and disagree a little bit here.
Other than the very, very large tech companies, nobody really yet has a real AI story to tell. And the question is anybody going to emerge?
So there we have a bit of a checkup with Steve Eisman. In summary, he thinks that the market's a bit too excited right now. He's expecting a little bit of a pullback. He thinks that you should stay invested or at least have significant exposure to the Mag 7. Don't avoid these companies. It's too difficult. He also believes that Bank of America or any large bank is not a great investment right now. He thinks that interest rates are probably not going to be cut as aggressively as the market's expecting. And he thinks that AI will be more of a narrative-driven thing than actually having an impact on earnings in 2024. Let me know if you agree with him or disagree. For the most part, I find myself agreeing with Steve Eisman. I think that he does a pretty good job. So that's all for now. See you in the next one.